Good morning. This morning, we are getting into what I call investing 101. And 101 investing for me is all about understanding the underlying market or environment that we are in when we're investing. Because without that foundation, it's very difficult to make informed decisions. And this community is all about informed decision making. It's about empowering you through the knowledge that you need and building up skills. So, one of the things that I really struggle with for women is that we're always looking outside ourselves for advice, guidance, for somebody to tell us what to do with money. And I believe that's because society, the environment that we've grown up in, for those of us that are in midlife, which should be most of you really, that are on this call or watching the replay, uh, we've grown up in an environment that has taught us to be small when it comes to money, that has taught us that we can't understand it, that it's super complex, that it is not women's business. And although that sounds extreme, when you look inside yourself and you ask yourself why you are in this community, why your money situation is how it is, why your knowledge levels are where they're at with money, I think that you'll probably find that it is true that throughout our lives, women are not encouraged in the same way that men are to explore money, to take risks with money, to really put yourself out there to make lots of money. We this week learned three key concepts about investing. And those three concepts, if you didn't catch them, please go back and watch those short videos because they really are the foundation of investing. And those three concepts were: concept one was about interest. So, the big deal about the stock market is the type of interest we can earn when we're investing on the stock market and the amount of interest that we can earn when we're investing on the stock market. Secondly, we learnt about risk and reward. So, we talked about the risk of investing in the stock market as compared to other types of more cash-like products like savings accounts and transaction accounts. So we learnt about risk and reward. So the reward in low risk is lower. The reward in taking higher risks when it comes to money is higher. Okay, we then learnt about the third concept, which was diversification. So to diversify is to spread things out into more different places. And we talked about the not putting all your eggs in one basket, because if you put all your eggs in one basket and then you drop the basket, we get left with lots of cracked eggs and we get left with a big mess. So you can now see my piece of paper here that I've got ready to do some drawing. And what you can actually see there in front of you is one that I prepared earlier. So when you do the Midlife Money Comeback Challenge, when you do the Women's Money Success Path, we really go into depth on these concepts. So what I'm going to draw down the bottom here is what I call my risk line. And all the way down here on the left, we've got low risk, and all the way up here on the right, we've got, not risk, we've got high risk. Okay. As we've already explained, this is not just risk, it's also reward when it comes to money. Okay. So risk and reward. Okay. I'm also just going to put like a little line kind of somewhere in the middle because that line kind of tells us where kind of we're tipping over between the two risk levers. Okay. Right. So all the way up the very high risk end, when we're thinking about investing, what sits up here is what I would call single asset class. Okay. So remember, if you listen to the little video yesterday, I talked about if you were investing in Coca-Cola and something had gone wrong with the formula for Coca-Cola, there was something toxic in there, and the product had to be withdrawn. Imagine what would happen to that single stock if that is where all of your money was held. Okay, so that's a single asset class, and that's an example where, in essence, we have a single company, and that company is in one sector. Okay, and that sector, when it comes to Coca-Cola, is FMCG, so it's fast-moving consumer goods. That's what that sector is called. And you can imagine all different types of sectors. So we could have Nike, which is obviously retail. We could have property. So you could be investing in property as a single asset class. There are all sorts of examples of single asset classes. Pharmaceuticals is another one. So if you are invested in a single asset class, a single company in that asset class, that is the very highest risk you could be taking in the stock market. And this is what day trading is really when we think about it. So day traders who hopefully have studied, they have spent time, kind of looking into companies and doing their research, and they are on this all day, every day. I don't know about you, but for me, I don't have that kind of interest. I don't have that kind of burning passion to be looking into this intraday, and I certainly don't have the time. My passions lie in other places. Next, we are going to move on to the other end of the spectrum. So now, nothing is ever no risk. People often say to me, well, what about cash? Surely cash is the lowest of low risk. Well, kind of, except cash loses value. So this is hard physical notes and coins. It can be stolen. It can be exposed to things like fire or flood. And so therefore cash itself is not even completely low risk. But it is, in the scheme of things, compared to investing in the stock market, arguably, it's lower risk. All right, so let's just talk about these other, kind of types of bank products that sit down here. We've got our transaction account. So this is our everyday account. What kind of interest is that earning though? It's really pittance, like it's 0.01 to 0.03 kind of percent. The reason for that is because the way that banks make their money is when you give them money, they, in some cases, are able to then do other things with that money. So they lend that money to other people and they charge other people interest. That is where we are talking about debt products. So if you have a credit card, if you have a personal loan, if you have a home loan, those are all examples of where banks are lending you money and charging a high amount. So the problem with a transaction account for a bank is that it's completely liquid for you. That means if you want that money, it has to be available. Okay, so the bank can't really do much with that, and therefore they're not going to pay you much for the pleasure of holding that money for you. So let's add in some other types of accounts into our kind of little party over here. Then we've got an everyday savings account. And those everyday savings accounts are sitting pretty close from a percentage point to what's called the cash rate. So the cash rate is the kind of the underlying rate of cash that's set by the Reserve Bank, the government bank in your country. In Australia, it's called the Reserve Bank of Australia or the RBA. Now, every month they get together and they say, where is unemployment? Where is, where is the price of goods? Where is debt in our country? And what is the inflation amount? Okay. Inflation is a really important concept for us to understand. Now, most countries are trying to keep their inflation at somewhere between 2 to 3%. And the way to think about inflation is that that is literally just, and this is a very simplified way of thinking about it, but that's what we're all about here. Inflation is the difference between um, the amount of money that you are earning and the amount of money that you need to pay to acquire goods and services. Okay. So that inflation rate is always shifting and it's being controlled by the government. So when they are looking at how much people are earning and how much of their hard earned cash they have to spend on goods and services, they are setting that cash rate to try and control the distance between those two things to the perfect amount so that consumers are able to live a good life. That's the theory, right? And when you think about inflation over the last few years since COVID, what has really happened there? When you think about how much pay rises have really kind of stopped, your pay rises are kind of really just moving along very, very slowly. So you're getting very low percentages, if anything. Many companies, the big corporates, are giving pay rises that are in line with inflation. So if we think about that inflation target of 2 to 3%, you're probably sitting there thinking, yeah, that sounds about right. Maybe you haven't had a pay rise recently. Maybe you have had a pay rise, but it's been quite low. And for those of us that, kind of have been in the workforce since the 90s, I used to get massive pay rises when I worked in corporate finance companies. Like we're talking 5 and 6%. And then I would get bonuses on top of it. That has really cooled, especially since COVID. Okay. So if I'm only getting a 2% pay rise and inflation is 3%, so the money that I am earning is not even able to cover the increase in inflation. That is where we start to see the cost of living crisis come through. Because if I had no pay rise or I had a 2% pay rise and inflation is 3%, the cost of my living, there is a gap there of 1%. So my money is going not as far as it used to. Therefore, I don't have as much disposable income to save. Okay. So that's a long way around of saying that in Australia, the RBA is keeping our cash rate sitting between 3 and 4% at the moment. Okay. It's a bit of a seesaw. So the savings rate that you can get in an everyday savings account is going to be close to the cash rate. So let's just kind of say, for argument's sake, that that's around 3%. All right. We then have high interest savings accounts. And these are types of accounts where the bank puts more conditions on you to pay you a higher rate of interest. Those types of conditions are things like you must increase your savings amount by X amount per month. You mustn't withdraw anything from that account in the month to get the bonus savings amount. So these are the types of conditions that the banks will put on you to give you a higher rate of savings. Okay. So what they might be saying is the standard rate in this account is 3%. But if you meet our conditions, we will pay you 4%. So that's a whole extra percentage of interest for your hard earned cash. But you do have to keep an eye on those conditions. Okay. Now, let's talk about a couple of the other types of accounts that really tread a line between the cash type products that are given to you by banks and stock market type products. Term deposits are still cash-based products, so they're still offered by banks. And I'm just going to draw this line on here. So term deposits are, again, going to be really kind of tracking that cash rate. But what they're offering you is certainty of the amount of interest that you're going to be getting back. Whereas our savings accounts and our high interest savings accounts are always going to be shifting up and down as the Reserve Bank changes the cash rate. Okay, so it's never certain. Term deposits allow us to lock in a rate for a period of time. They usually are paying simple interest. So if you put in a capital amount and you decide, say, for example, you're going to have a 12-month term deposit. So you give the bank a capital amount and they say, great, thank you so much for giving me that money for 12 months. I can now take that money and lend it to others so that we can make more money ourselves as the bank. And we are going to, in return for that, give you a guaranteed rate of interest at the end of the 12 months based on that capital amount. Let's say you are close to retirement or you are in retirement. Term deposits are a great vehicle for some of your money. They are reasonably liquid, so you may lose your interest if you break the term deposit. It may take you a few days to get that money back after you place the instruction to break the term deposit, but the bank must give you your money back. Now, the other thing that I want to talk about ever so briefly is bonds. In essence, bonds are a part of the stock market environment. Okay. What bonds are is where usually governments, sometimes big corporates, will sell you a bond, and its purpose is to give you a fixed amount of income based on an interest rate that is attached to that particular bond. Okay, so it's a regular income and it is guaranteed, but there are decisions that you need to make in buying a bond. Okay, so you can have a bond that is protected, in which case your interest rate of that bond amount is protected for the period of time that you have purchased that bond for. Or you could have a growth bond. What we are talking about now is mutual funds. Okay, so very high risk, picking a company and buying a stock directly in that company. All the way down the other end, there is a concept of a mutual fund. And a mutual fund is provided by a company like Vanguard or Fidelity, or in Australia, InvestSmart. These are big companies with big, like billions of dollars of funds under management. And what they do is they create a investment product, which is called a mutual fund. Quite often, these are market trackers. In Australia, these would be trackers that are tracking companies on the stock exchange in Australia, so the ASX. In America, it could be tracking the NYSE, so the New York Stock Exchange, or it could be a particular collection of companies like the Standard and Poor collection of companies, which kind of looks at the top performing companies. Let's say it could be the top 250 companies on the stock exchange in question. So I know it's a lot to wrap your head around, but a mutual fund offered by a big company that has a huge amount of money sitting underneath it. They have lots of staff, lots of computing power, lots of algorithms, and they are offering millions of people a tiny piece of lots of companies. So what that's doing is that is diversifying our risk. And not only that, that risk is further reduced by the fact that it is a huge company. Okay. It is that huge company that is doing all of the research, and they're tracking the market, and they have statistical models, and they have market tracking models. It's a whole thing. What's really great for us is that as retail consumers who want to take advantage of what the stock market has to offer, but we don't want to expose ourselves to that huge risk at the top end of the market, this provides us with a very solid way of achieving great results with the amount of interest that we can get back for our capital that we are investing in the stock market. Now, what I wanted to know, and I'm just going to talk to you about stock market performance. I want to share my screen and I want you to be able to follow me doing this live, because really you should be able to do this yourself. We're just going to look at stock market performance last 100 years. Super easy. All right. Here we go. So now I've run this search many, many times. So on this occasion, I do know that we can trust AI. It is well documented. So over the past 100 years, from 1926 to 2026, the US stock market has delivered a strong long-term upward trend despite major crises. Over 10%. Okay. Now, what I want to say about that is that there are some concepts here that you're seeing that we've been talking about. So inflation. Money is always losing value as time goes on because of inflation. So when they're talking about this real inflation adjusted return, basically what that means is the money that you have today is not going to be worth the same in 20 years' time because inflation is always tracking up. If I was to explain to you that when it comes to the type of interest that we've talked about, so we've talked about our savings account at 3%, our everyday savings account. If inflation is always roughly tracking at 3% for the next 20 years, we're not going to really see growth. And that is where the compound interest on the stock market is able to outperform inflation. Okay, so 3%, roughly the same as the cash rate, roughly the same as inflation, compared to over 7% in inflation adjusted terms, is really, really an important distinction in the way that we can grow wealth. And that is why the stock market gives us this incredible opportunity. That said, we do have to remember at all times that the stock market is subject to market forces. It is always going up and down, and those crises that we've talked about are what we need to keep an eye on, because where our money that is at call is liquid, and if there is a market event like the global financial crisis in 2008, like COVID in 2020, our ability to get our hands on cash reduces. Okay, especially cash that is in the stock market, because the market responds and our portfolio can really go down in a very short amount of time. Doesn't mean it's never coming back. Okay, what it does mean is we need to be able to ride out that time period of the crisis with other assets. Okay, so when we talk about diversification, that is what we're talking about. We're talking about having different types of assets in our portfolio, and that's what we're covering here on this little picture, is all of the different types of assets that we're looking to build up. So back to our mutual funds, okay? Love me a mutual fund. So we're still up here in the risk. Mutual funds are absolutely fully invested on the stock market, but big companies are selling us a little slice of lots of companies. So our risk is diversified. And depending on the type of portfolio that you're invested in, and what I love about these companies is they can now offer you a low risk portfolio, and they will tell you, this is a shorter time period. So, let's say 3 years. And they will tell you the type of interest you can expect to make here. So it could be 4%. What's interesting is, depending on the environment, that low risk is kind of interesting in terms of the interest rate that you could be earning. Then they might have a medium risk. And they might say to you, this is going to be more like 5 to 7%. But you really want to expect to be able to hold that money in there for more like 5 years. And then they might say we have a high risk and even a very high risk. Okay. And this could be 10% and up. And that high risk might be 7 to 9% that you'd be expecting. But the time period needs to be really getting up into that longer time frame. So When you do the midlife money comeback challenge and you look at the goals that you want to achieve in your life, this is where we're thinking about, well, I want to retire in, let's say, 10 years' time. How could I increase the amount of money that I have available to me at retirement? This is the type of strategies that we're really talking about here. I want to buy a house at the point that I retire, or I want to buy a unit, or I want to buy a little piece of land that I can put a tiny house on. Again, that is where we want to be looking to the stock market to help us compound our growth. What I want to do is I want to finish up with talking to you about compound interest. Let's just jump into this compound interest calculator. So, what does compound interest really mean? Well, compound interest just means you're getting interest paid on your interest. And the magic about this is the deposit and the compound frequency and the time. Okay. So let's say I am 40 and I am planning on retiring when I'm 60. So that's 20 years that I have available to me. If you're 40, you might be tempted to think it's too late. God, I'm already 40. I'm starting from nowhere. I've been divorced. I just don't see how I'm going to make this happen. Well, I have got really good news for you today. So let's say you come up with a deposit of $1,000. Let's say you're in a job that's earning $70,000 a year, and you go through the midlife money challenge and you establish that you can save $500 a month. Amazing. Okay. We're going to increase this to 20 years because you've got a strong goal. You know you want to have a significant amount of money in an investment account for you when you retire. Okay. Now remember about our risk here. So 5% interest, you would only be investing at very low risk. And if you're 20 years out from retirement, I really want you to question if that's the strategy. I want you to really think about your own risk profile. What kind of risk are you willing to take over that 20-year period, knowing how the stock market has performed? Let's have a look at what's happened. So, wow. So my initial deposit was $1,000. I put in $120,000. Okay, that is a significant amount of money. But you know what? Time passes and you've got a big goal. You can commit to this. Look at the amount of interest you can make, even at low risk. $87,000. What the actual hell? I hope when you look at this, you are thinking, what the actual hell? This is unbelievable. Let's just look at those other risk profiles. Let's update this to 7%. Okay. $143,000 in interest. Far out. All right, let's just be really wild. And listen, I don't normally model based on that very high interest amount, but let's say we were lucky and that is what happened. We would be earning $266,000 in interest, outperforming our capital input significantly. And we would end up with $387,000 in 20 years. I just think that we do not spend enough time getting excited about this. And yes, there is risk. Yes, there is market forces. Yes, nobody knows where we're going to be or where the stock market is going to go in 20 years' time. But it's worth thinking about and it's worth understanding. What if we increased our regular deposits to $750? What would happen then? Well, we'd end up with $500,000, over $500,000, and the amount of interest that we would have earned is almost $400,000. I just think that, you know, that quote that says that compound interest is the eighth wonder of the world. I think it's true. I really do think it's true. And yeah, I really encourage you to get onto the compound interest calculator and to start looking at what your big goals and dreams are. And this is why I teach what I teach. This is why The Comeback Challenge is there to pique your interest and to help you build some foundations. When you're ready, you want to upgrade to premium and you really want to get over into the women's money success path. You can either do that self-directed or you can go VIP. And right now for founding members, premium, $7. You are locking that rate in at $7 a month forever or $42 a year. I don't really see how you can afford not to keep on this journey. If you want to do the Women's Money Success Path with me in person, where we do it together, I am available to you for one-to-one coaching and teaching. That is $500 right now. Anyway, enough of that. I hope you have a fabulous day. See you later.